Thank you very much, Darby, for the introduction. Just to make sure that everyone can see my screen. Seems to be all working. Thank you very much. I'm Pierre de Klerk from Boutique Investment Partners, and I would like to give you, following on what Darby has said about the economic side, I want to give you a bird's eye view as to what the macro considerations are that we are taking into account from the investment and portfolio management perspective at this stage, and what we feel we need to give attention to. So the first slide is the only slide that has words and text on. Thereafter follows a number of graphs. So this is really the high-level summary. And the first point to make is that after the crash that we had, risk assets are very cheap. Globally and locally speaking, assets are a lot cheaper than what they were at the end of last year before the market came off. SA equities are cheap. SA properties are also cheap. There are structural issues we need to discuss around SA property, but specifically SA equities on a 3 to 5 year view offer very good entry points and very good opportunities, and I'll illustrate that somewhat more. The second point is obviously the medical side around COVID-19, and from a markets or investment positioning point of view, the trajectory of that is going to be very important. What do we mean by that? Basically, we need to assess and we need to learn as we go forward whether this is going to be a case of the global lockdowns working and the COVID epidemic basically being brought under control in a once-off through the lockdowns, or whether there is a risk of further resurgences and second and third or multiple waves of this. Therein lies the risk, and we have a reference point in that, which is the Spanish flu in the 1920s. So we're very well aware of what the risks are. We need to take that into account. The next point relates to what the economic recovery will look like. And we think it's going to be a U-shaped, some sort of a U-shaped recovery, which means, as Darby has pointed out, the next set of numbers from around the world is going to be terrible, frankly. In the US, the Q2 quarterly growth will probably be -15 if you annualize it. But then we expect some stability in the third quarter and then a strong recovery thereafter because of all the stimulus and the policy measures being thrown at this, as Darby also mentioned. So this, if we correct, this is going to play out, as I said, in some sort of a U-shape over the next 3-4 quarters, but very importantly, the market is going to look ahead, and the market will sniff out, where the improvements happen and how the thing is developing. And we need to be acutely aware of that as well. The market typically looks 6 to 12 months ahead at least, and discount what the economic news and the reality is that is playing out. The next very important point is that monetary and fiscal stimulus around the world has been aggressive and it's been massive. Darby mentioned that. And it will have some effect. They've already put a floor under the functioning of the financial markets. So initially, when the market started falling, the concern was about liquidity and about the functioning of the financial markets. And through the various measures by the Fed, they have really ticked that box or addressed that. So they've put a floor under that. And there's interesting examples. You may have read that the Fed partly goes directly to companies, not through the bank system anymore. So now you have this unique situation where the Fed is prepared towards medium and small companies to act as almost like a commercial bank, and an unconstrained one. So it's quite different from the approach in the global financial crisis of 2008. The Fed is much more aggressive, and across the world, in Europe, in Japan, there is a lot being thrown at this problem. So from an investment point of view, if you think about portfolios, we must also be cognizant of the saying that says, don't fight the Fed, don't fight the wave of support and liquidity that is being thrown at this problem. Another few points, Darby mentioned this already, the rand is cheap. In that lies opportunities. There also lies some risks if one rushes out of the country now with all your money, that the rand might come back as it did after 2001 and do damage to your global portion of your portfolio. So we are very aware of that and take that into account. And then equities are cheap, as we said, but there are other asset classes that are also cheap, and SA bonds on a global basis stand out as offering very good yields, 7% above inflation that you can now lock in if you buy SA government bonds. So I think there's, and hopefully as I'll illustrate when you look at the graphs, there's positive things to take out of the response, at least, to the current situation. But lastly, and tying back to what Davy said, one must realize what the South African realities are. And that's a bit of a caveat. Our economic and our market prospects certainly have heightened uncertainty compared to developed markets and some of the stronger emerging markets. And that relates to our ability to cope with the pandemic. And we'll talk about that a bit, but it also relates to our fiscal situation. So one needs to be cognizant of our own realities, but I think also we are in a good neighborhood of emerging markets. And one possible play out of the global scenario is one where China, as a massive and significant player and contributor in the global economy, stimulates aggressively, come out of this first and drag the other emerging markets along with him, and therefore the South African ship rises on the tide of other emerging markets. So I think if one gets skeptical and gloomy about our domestic situation and the challenges we face, one must always consider that against the background of a much bigger emerging market complex of which we are part and which have very strong drivers in terms of big economies like China and the likes of Brazil when they get their act together. So that's the high-level summary, and now I'll color it in a bit for the next 10 minutes or so by reference to a few graphs. So firstly, just a market snapshot of what happened in the first quarter of this year. And this is the South African market, and I've circled there in the middle our year-to-date performances of our asset classes, mainly equity and the different sectors. And clearly the numbers were very bad. The market crash was fast and furious. It was a flash crash, and the first quarter numbers does not look good. And I purposefully did this graph to the end of March because this is the kind of numbers that investors will see on their investment statements that will be arriving from the LISPs this week and the week hereafter. So one can understand why investors might be concerned. But very importantly, the market has already had a bounce back, and the market bottomed around about the 23rd of March, and it's already up in excess of 20% from those lows. So it was a really fast movement to the downside, but once the Fed and the policy responses kicked into action and put a floor under it, there was a equally quick recovery. Now, one might be concerned that this is a classic dead cat bounce, and I'll talk a bit about previous developments of bear markets. But suffice to say, the question might be, what did we do in portfolios under these circumstances? And one thing that we didn't do was sell into this weakness and at the bottom, because when things happen so fast, when it comes, as the faster it comes down, the bigger the risk becomes for a snapback, even if it's temporary, and that's exactly what we've experienced now. So we would really guard against selling out at lows and locking in losses. If we turn to the medical side, there's just a few slides about this, and this is critical, as I mentioned, for us, because we need to position portfolios for multiple scenarios. The medical side around COVID remains uncertain, and that will have economic repercussions, and we must position clients' investments and portfolios to not bet on a single scenario. So it's critical for us to know whether this, the probability is that this will end in one wave, or whether there's risk of multiple waves. And the data comes in the whole time, and one needs to assess this. But the one thing we can say, and this graph shows the new cases up until the end of March across the world. And subsequently to this, if you read the news, you would know that in Italy, in New York State, the new cases seem to have peaked due to the more aggressive lockdowns that's been implemented. And there seems to be a plateauing in the cumulative cases as well. So one can take a positive view on this, or some positive aspects to think that it might well be that lockdowns work and we get this under control. Also, I think it's worth to mention that the response globally to try and find a solution of this have been significant, both in terms of financial means thrown at this, but also human ingenuity. So you might have read or know that there's currently 70 different vaccine projects on the go globally to try and find something that can resolve this. And there's already 3 vaccines in early stages of testing. So I think that again speaks to the fact that a lot is being thrown at this, and also to dealing with it. So firstly, looking for a vaccine, but also dealing with the impact of that. So it is also interesting to note how ingenuity just kicks in. Globally, GM, the car manufacturer, Tesla, the car manufacturer, Dyson, the vacuum cleaning manufacturer, they are all building ventilators now. They have repurposed some of their production lines to build ventilators. And in South Africa, Denel and Defy are going to start to do it. And they're working on a generic spec for a basic ventilator that they think they can produce 10,000 of them in South Africa by June. So again, making the point that there are significant responses to this situation. If we go on and conclude on the medical side, this is the other side of the coin that we need to be aware of and worry about. Well, not worry about, but think about in terms of a probability of what could happen in a worst case scenario, and position portfolios to also cover this. And what this shows is the Spanish flu epidemic in the 20s that really came in multiple waves because it wasn't brought under control in one shot. But I think one can be optimistic that the world has come a long way in terms of medical advances and so forth in terms of addressing this. But this clearly remains a risk and something we take into account when we think about defensive positions in portfolios versus more aggressive positions focused on the opportunities. This is the South Africa experience. We are the blue line versus the UK experience of infections in the orange line, and we have broken the trajectory, and it perplexes everyone. If you listen to the press conference by the National Health Department, there might be different reasons. It might be because our population is more resilient because of TB vaccinations and antiretrovirals. It might be because our testing is maybe a bit behind, but it looks like we are backing the trend. We can't be complacent, but it looks like our lockdown is working and that we are having a positive impact on this. If we now move on to the markets and the economics, this slide shows how quick the response by the Fed was to support the economies and the markets compared to the financial crisis. The black line is the Fed's response in terms of the increase in their balance sheet post the financial crisis, and the green line is the response now. And as you can see, it is much quicker, much more aggressive. They are really throwing a lot at this. And numbers are coming in the whole time. This relates to the Fed's expansion of their balance sheet. But if you look at the total package of what will be done in the UK, initially they did 2 trillion of stimulus. That will go up. And I've seen research that said if you look through all the measures that they're taking, and I mean there's a list of 30 different things that they're doing, then it'll come close to 10 trillion which is half of US GDP in a year. So a lot is being thrown at this, and one must think carefully if you believe this will not have a supporting effect for the market. As I mentioned in my summary, markets are cheap. This slide shows various markets, their PEs and their price to books. In the third and the second columns from the right, it then shows in what percentile of cheapness you fall as a market. And as you can see, if you look on the South Africa line, our market is now in the top 10% of cheapness over time. Or putting it a different way, we are only this cheap in our history 10% of the time. So markets are really cheap. If we look at emerging markets, same story. So this is the whole emerging market complex of which we are part, and emerging markets as a whole are cheap after the corrections. And we are part of this. Our assets offer good value, as does those of other emerging markets. We also mentioned our bonds, and if you just look at the graph on the left-hand side, it shows that our 20-year government bond now offers you a 7% above inflation prospective return, where typically over time it is supposed to offer you 2 or 3% above inflation. If you look at where the average by eye of that gold line over time is, it's around about the 2 to 3% basis. So for balanced funds, for example, like we manage, this is a really good opportunity to, alongside equities, also take positions in bonds, take advantage of these particularly good real returns on offer. Harvey mentioned the rand, and for me just to reinforce that the rand is very cheap where it currently is. And in that, as I said, is also a bit of a warning. If you look at 2001, which is in the middle of the graph, after 2001, where intraday the rand got to 18 to the dollar and 25 to the pound, subsequent to that it came down all the way, and had you rushed out of the country with all your money in 2001, you literally would have lost half of that through the rand strengthening subsequently to that. So we also need to take this into account, and at the margin in portfolios we have brought back a bit of money to guard against the risk that the rand might strengthen. So what does bear markets typically look like? On this slide, the gray line is the current market fall that we experienced. The green line is the 1987 bear market, fall and subsequent bear market, and the brownish orange line is the 1929 market. Now, why this is relevant is because investors might take the view that they'll wait for more stability, and there might be a second testing of the lows as they were in 1929. Common knowledge is that the second fall in the 1920s was related to poor policy management by governments and policymakers. If you look at 1987, there wasn't really a testing of lows afterwards. So this is just to make the point that bear markets can have different developments, and it's not to say that what we've seen now since the lows is a dead cat bounce and we will turn around and test new lows again. It might happen, but one can't certainly bank on that. If you look at the green line, it bottomed in 87 and it was prolonged sideways, but it didn't collapse further than that. And it's also important to know when one typically makes money in a market cycle. And what this slide shows is post the market crash, over the next period divided into 10 deciles where you make the money. And what is interesting is most of the money you make, and it's quite intuitive, after the recovery. So the initial bounce after the market has crashed is typically very strong. Then there's a bit of a lull in performance. And then also interesting, in the very late stage of a bull market, when the party is at its red hottest, is also when you make outside returns. So psychologically, this is very difficult to deal with because straight after a crash, people are very reluctant to get back into the market. So they typically miss that first tall bar. And then right at the end of a bull market, as the news about expensive markets start hitting the headlines, people typically exit too early and miss that strong return at the end of it. And therefore, you might have heard that what is always said is that the average investor gets a much lower return than what the market gets. And it's because of this behavior of people due to emotional reasons being out of the market at the wrong time, exactly when the big returns manifest. So in summary, market timing and timing the bottom is almost near impossible, and we don't advise people to try and do it, and we don't do it in our portfolios. Investors also don't need to feel that they need to do something because you have portfolio managers like ourselves that you can leave things to, and we are not doing nothing. We are stress testing our models. We are relooking the structure of our portfolios. Managers are rotating out of companies that have dealt better with the recent environment, and they rotate to companies that maybe unfairly were sold down and now offer better opportunities. And us and other managers add to risk now so that we don't lose out on the recovery that comes. So those are the actions we're taking in portfolios. And what matters in portfolios is that we need to have a balance between the opportunities, which is clearly the valuations that are very good, and then the risks. And how does one do this? You position in the cyclical exposures, typically through the value managers, and that typically captures exposures to resources and financials, because if the economy recovers, that's where the big gains will be made. But one balances that with a bit of defense in portfolios, which typically is your quality exposures like consumer staples. And that, if the market remains tough for longer, will do better, because in that lies a bit more defense. So what have we been doing? We've been relooking our portfolios. We've ensured that there's proper style balance in this barbell approach that I described. And at the margin, we've added to the quality style or to the more defensive exposure. So we don't want to be out of equity, but we want to tilt it ever so marginally to exposures that will give us some protection in the short term. We've added bonds to portfolios and we've rebalanced back to at least neutral weights of equity exposures, again, so that we don't lag and are left behind as the market recovers. And then lastly, as I mentioned, we've brought some money back and certainly made sure that we're not in excess of the limits of what we can have overseas, because we think there is some risk that the rand can come back. So my key recommendation would be leave it to portfolio managers that are doing their jobs at this stage. Stick to your investment plan that is based on your risk profile. Medium to long term, there are very good opportunities offered by valuations where they currently are. The short term might be challenging, but we are deploying our mental skills and capabilities to deal with it as best we can and to focus on the longer term. Thank you very much for the time.
Thank you.